Hello, my name is Elliott. I'm editor of Personal Finance and the Energy Strategist. Today I want to talk about a little sector of the energy market that doesn't get that much attention most of the time, and that's nuclear power, and more specifically uranium mining. Now, as most of you are well aware, nuclear power plants use uranium or enriched uranium as their basic fuel source. The uranium market's pretty unusual for a commodity in that very little of it is actually traded on the spot market. In other words, most uranium supplies are locked under multi-year deals between the major mining firms and a major utility. So, for example, a utility like an Exelon that has to refuel their existing power plants would go to a major producer like Cameco and contract for a certain amount of uranium to be delivered each year or on some sort of a fixed schedule over many, many years at either a preset price or a price that sort of adjusts gradually over time. But somewhere between about 10 and 20% of the market, depending upon the year, is traded over a spot market, meaning that it is sold for immediate delivery. And it's actually traded in the form of uranium oxide, which is basically raw uranium, actually a fairly common element in the Earth's crust. Earlier this decade, or earlier last decade, and back in the 90s, uranium prices were very, very depressed. Uranium prices traded under $10 for a pound of U3O8, which again is the raw uranium oxide. Sort of in around the 2002, 2003, 2004 period, we began to see a real uptick in demand in the spot market. Basically what was happening was there's a lot of talk about new nuclear power plants being built. The main driver of that, of course, has not been the developed countries, not been the United States or Great Britain or Eastern or Western Europe, but it's really been the emerging markets, in particular China. China put together some plans showing them adding as many as 30 or 40 new nuclear power plants. They have been aggressively constructing new nuclear power plants. Russia is another major story. Russia is building new plants to offset some of its domestic natural gas use, of course allowing the country to export more gas to Europe. India is another major story out there. India is not a signatory to the Nuclear Non-Proliferation Agreement. Therefore, it's had trouble in the past importing uranium that it needs to run plants. But some deals with the United States and potentially other countries have made it easier for India to import nuclear technology. As a result, they look likely to go ahead with a pretty aggressive nuclear expansion plan. In the developed world countries, looking at countries like the UK, for many, many years, thought to be a pretty anti-nuclear country. It was mainly felt that they would allow their existing plants to sort of wind down over time and replace it with some other source of power like natural gas. But they really found that if they wanted to cut their carbon dioxide emissions, and the nuclear power plants emit no carbon dioxide, and wanted to meet their goals in terms of the Kyoto Agreement, and also wanted to cut their dependence on imported fuels, imported natural gas, imported coal, etc., they would need to pursue nuclear, at least reinvigorate or re-extend the plants they already have, if not adding absolutely new capacity. Italy, another country, since really the Chernobyl disaster, has basically had a moratorium on new nuclear power plants. Berlusconi administration has talked about starting a new nuclear program. United States, of course, loan guarantees added as part of various energy bills. We're starting to see construction licenses and whatnot filed for new nuclear power plants. And it's likely, 10 years ago, probably most people would have told you new nuclear power plants will be built in the U.S. Now it looks likely that we will begin to see at least a few new reactors here over the next decade or so. So what it all means is we saw an increase in demand. At the same time, supply is pretty constrained. Now, why was supply constrained? Well, as I mentioned earlier, prices were really, really low back in the 90s. You had all sorts of alternative or what are called secondary uranium power sources. Examples would include Russian nuclear warheads, which were actually reprocessed to make nuclear fuel. That agreement actually ends in 2013. The Department of Energy, as well as the Department of Energy in other countries, contain significant or own significant stocks of uranium, which they would gradually sell over time. The other thing, of course, is that back in the 80s and late 70s, when a lot of companies were building new nuclear power plants, they went out and contracted for uranium supply years into the future. They had plenty of availability under those contracts at attractive prices to meet their needs. No need to go out and arrange new supply. So what happened? Uranium prices collapsed, more supply than demand. Nobody wanted to build a new mine. Why spend billions of dollars developing a new uranium mine if you're only going to get $10 a pound for it, maybe even less on a long-term contract? So really all that survived were a handful of larger producers with extremely low-cost mines. The other type of companies that survived were major miners that mine things like copper, that also produce a bit of uranium as sort of a byproduct of their other mineral activities. These companies continue to produce, but really mine supply, the actual amount of uranium coming out of mines, didn't really equal what was getting used every year. There was a pretty significant deficit of as much as 30 or 40% of the market at one point, simply because no new mines were opening up, and companies were simply running down existing stocks of uranium to meet demand. As those secondary sources have begun to dry up, we did see an uptick in demand from new plants. Uranium market, again, a very thin, illiquid market, saw a lot of trading activity. We also saw the entrance into the spot market of a number of speculative funds. Basically, traders looking to bet on an upward price in uranium started buying spot uranium. And what we saw is a real tightening in the market. Uranium prices climbed from under $10 a pound in, say, 99, 2000 to around $150 a pound at their highs in 2006 and 2007. Hit an actual high in June 2007 and since traded back down again. Now what we saw was that speculative activity in the uranium markets got a little bit too hot. We saw the global recession and financial crisis cause a drop-off in demand in the spot market. Uranium prices pulled back down into the 30s per pound, still well above where they were back in the 90s, but a fraction of their 2007 highs. We're now once again seeing a break higher in uranium prices. What we're seeing is that a number of utilities are becoming concerned about the 2012-2013 period. The reason is that there's still probably not enough mine supply out there to meet all the demand, and at the same time, a lot of these secondary sources are drying up. The stockpiles are running down, and again, that Russian deal to downblend nuclear weapons ends in 2013. That removes a big source of secondary supply. So uranium prices have climbed back up to the upper 40s per pound, and I think there's a scope for them to go quite a bit higher. It may be a bumpy ride here over the next 6 or 8 months, because right now there's probably enough supply, but I do think we're going to see this market tighten up considerably in 2012, and we'll probably see spot prices run up a great deal ahead of that. How do we play this? Well, the most obvious way to play it, of course, is with major uranium mining companies. These are companies that actually produce and sell uranium to the utilities. These are the companies that have survived that long uranium bear market of the 80s and 90s. One of the classic examples, the largest pure play in the world, is a Canadian company called Cameco. Trades on the New York Stock Exchange and on the Toronto Stock Exchange. In New York, the symbol is CCJ, and in Toronto, it's CCO. The world's largest independent producer of uranium, major mines in Canada that are very, very high ore grades. In other words, there's a lot of uranium contained in the rock, makes it very, very cheap to produce. They can make money even with uranium prices back down in the teens or low 20s, whereas a lot of producers really need $40 or $50 uranium to make a whole lot of money. They're also likely to see a great deal of production growth here over the next few years, opening up a couple of new mines in Canada, as well as making a lot of investments overseas in places like Kazakhstan, which has been a major historic source of uranium production. They also may be doing some mine expansions in other countries such as Australia and the United States eventually. This is really the big player. I think it sees a lot of upside here over the next 18 months or so as spot prices rise. Also, check out some of the newsletters, The Energy Strategist. I have a couple of names that are much more leveraged. These are smaller companies that probably are going to see even greater production growth in percentage terms than Cameco, also more leverage to an increase in the spot price. Also check out Personal Finance. This is an area we do cover periodically in that newsletter as well. Thank you very much for listening.